Welcome to Truth, Money, and Freedom. Today is Sunday, the 28th of July, 2019. Guys, there's a wonderful story here. It's very well written, and it kind of encapsulates all the drama, the trauma, and the difficulties in today's markets because of the distortions. And I'd like to read a little bit of it to you. I've got it enlarged so you guys can read along here. The end game. In Fed we trust. Well, here we are. All roads have led to here. The combustion case outlined in April. The technical target zone outlined in January of 2018. Trade wars. 20% correction in between. Fed capitulation and response. Slowing growth data. Inverted yield curves. Political volatility. Deficit and debt expansion. Buybacks. All the big themes that have dominated the landscape in recent memory. They have all led us to here. Record market highs in high complacency in historic Fed meeting where once again a new easing cycle begins. Okay, this is important here. We never could normalize the American economy. We couldn't do it. They tried. They actually did give it a try, but the keeping interest rates so low for so long has done untold damage to the markets. Quantitative easing has done untold damage to the markets. We are in completely unknown territory at this point. This has never happened before. But what they're trying to do to fix it is not working. So they're going to resort back to the same scheme they used 2008 all the way to 2015 and actually 2016 to actually try and get a little bit more life out of this market. Okay, I'm going to continue reading. Like flies drawn to a light, investors have ignored everything that may be construed as negative as the market's prime price discovery mechanism. Central banks are once again embarking on a global easing cycle from the lowest bound tightening cycle ever. By far, many central banks such as Bank of Japan, the European Central Bank, have never normalized. The Fed barely raising rates before capitulating once again to macro and market realities. So what's the end game here? I have to ask given the larger backdrop. There's some tweets in here. What has all this produced? For one, the slowest recovery on record, but also the longest expansion. But this expansion has come at a very steep price as artificial low rates have led to massive record debt expansion, $250 trillion in global debt. So the world is sitting on over 13 trillion in negative yielding debt. Very important here to understand that. The 13 trillion is already actually in negative territory, as far as the bonds are concerned. Corporate debt ballooned to all-time highs and is keeping the zombie companies afloat. This despite search for yield is forcing pension funds into riskier assets. Next very important point. Forcing pension funds into riskier assets. This is how the pension funds are going to go bust. They're not going to be there for you and me. So that's a reality we need to talk about. 100-year bonds, that's in Japan. Japan has 100-year bonds, gang. 100-year mortgages. BBB rated credit is the largest component of the debt markets. Guys, for those of you who don't know, triple B rated credit on bonds is literally right before you hit junk status, junk bonds. Everything is distorted, and the desperate search for yield has produced another market bubble. How to define a market bubble? Simple. Take the valuation of the stock markets over the underlying size of the economy, and the size of this bubble is self-apparent. So this tweet covers that. The current U.S. stock market capitalization is 144.8% of GDP, peaked in 2017 at 154. For reference, the previous two peaks came in at 146 in 2000 and 137 in 2007. Asset prices remain historically disconnected from the size of the underlying economy. Sustainability is questionable. Okay, I'm continue reading here. I don't know what fair market value is in this distorted world. Like, I'd like to focus on that for a second. There, I've talked about this on this podcast many times. PE ratios for stocks, interest rates for bonds. I mean, this is how you know when there's an equilibrium, when things are overpriced, when they're underpriced. But these don't matter anymore. So how do you tell when you're in a massive, massive bubble? Well, we don't really truly know this anymore because PE ratios of about 30 to 35 seem to be the norm now. Literally about 3 times what PE ratios were considered normal before 2008. So the distortions are here. It's a reality. We're dealing with it, and I'm going to get to why that's happening in just a second here. But that's why you have to look for undervalued assets, because you don't know where we're going from here. And by the way, that doesn't mean that stocks PE ratios normalization might end up being 70 or 75. I don't know. Nobody knows. Okay, but the historic mean is significantly lower, and it's only truthful to acknowledge that central banks have sizably contributed to an artificial excess in the ratio. Very true. It's not central bank put. It's a central bank bubble. So, in other words, to be buying stocks here based on the Fed put is to believe that the central banks can maintain asset values above the underlying size of the economy at historically unsustainable level, especially in a period of slowing growth. Okay, let's focus on this for a second here. This is literally putting your faith in the fact that the Fed is going to continue to print money and people will continue to buy stocks with that money. That is the only reason to be in the stock market. That is it. And by the way, I'm talking about the aggregate here. There are undervalued stocks too, to be sure. I don't want to take that away from, the miners. For instance, silver and gold miners. I mean, they're undervalued assets. But by far and large, in the aggregate, extreme overvaluations in the stock market. Okay, for the period of the largest global central bank intervention on record, which was 2016 to 2017, U.S. tax cuts were promised to deliver 4% growth, and I remember that. Within the tax plan, we're going to easily see 4% growth next year. National Economic Advisor Director Gary Cohen, December of 2017. Gary was, of course, not the only one. Kudlow, who is a cheerleader, for Keynesian economics, Trump, Ryan, all the pushers behind the big tax cut were promising the moon. None of that came to fruition. The reality, we didn't even get 3% growth. And by the way, this is a lie. We're still negative on our GDP growth. I've covered this in previous podcasts. U.S. GDP for 2018 was just revised down to 2.9%. They always revise it down, by the way. Second quarter 2019 GDP has just slowed down to 2.1%, and that'll be revised down again as well, I promise you. And the entire globe is struggling with growth across the board. Things are getting worse and worse. Mario Draghi, head of the European Central Bank, said this week. And it is Germany, like for instance, Germany GDP forecasts, it's going down. Okay, so let's acknowledge the reality here. U.S. tax cuts have done absolutely nothing to change growth, the growth trend in GDP in this cycle. So we all know that because the tax cut ended up going to the 1%. Now, that's something that can be debated very easily, but it's also very easily proven. The tax cut did not help the middle class. It just didn't happen. So whether or not that was what Trump intended is irrelevant. Whether or not that's what Congress intended is irrelevant. It's helping the 1% mainly. That's where almost all of that tax cut goes. Okay, has it translated into corporate profits? Not really. Corporate profits before taxes in the aggregate peaked in 2014. Okay, this is not an image of expanding profits. What tax cuts have done is minimize the fallout of the decline. And here we go. I'm getting into the meat of the matter here. And this is what it took. A total collapse in tax receipts on corporate income. Corporate tax receipts are now lower than in 1995. Did you hear that, gang? Corporate tax receipts are now lower than in 1995. with an economy that is much larger. Okay, we now know what corporations are doing with the windfalls. It's not an increase in capex or business investment, R&D, both of which we know are declining. It's been a massive expansion into share buybacks. Companies are buying back their own stocks, thus shoving up their PE ratios. We can observe an accelerating trend similar to the one in the lead up to the 2007 market top, when the Fed was also forced to cut rates. And the force the Fed is, it has lowered itself into a corner where it can hardly afford to disappoint the markets. That's once again the crux of the matter now. The stock market is threatening to go down if we don't get cuts in the interest rates. This is, I think everyone understands this. So basically, the markets are actually starting to assert themselves onto the Fed. And will it or will it not help the economy? Well, actually, it may help briefly. But once again, these are not sustainable. And by the way, this stuff is happening all over the world, and they're saying the same thing. Central banks are actually starting to, mess up their underwear. This is not a good situation, gang. Okay, so let's get to the bottom of this here. So what in the world? So what is the world doing to combat slowing growth? Nothing. Everything is relying on central bankers to save us all again. Once again, a centrally planned economy. We centrally planned our way here. Can we centrally plan our way out? The answer is no, we can't. Mathematically, it cannot happen. So you have to start looking at what the consequences are, and we'll get to that in a minute. Politicians have given up, if they even really tried. They didn't really try. We've got one lone politician in America that I'm aware of right now that is talking about the dangers, and actually two. Now there's one Democrat doing it too. That's Elizabeth Warren, but we also have Rand Paul. Now Elizabeth Warren, her solution to the problem is, of course, more spending. And whereas the only solution to the problem that we had in the past, and by the way, I'm going to assert that 15 years ago is where they needed to start dealing with this. So it's far, far, far too late now. Far too late. So I'll get to that in another second here. There is zero discussion on structural solutions by anybody. Nobody is even trying to have the discussion. That's not essentially true. Rand Paul is trying to have the discussion. No one wants to listen. And I'm not a cheerleader for Rand Paul either. I'm just letting you know that he is probably the lone voice in the wilderness in U.S. politics right now. Economists are increasingly talking about MMT, which is money printing forever, modern monetary theory, which is literally the end of the Keynesian cycle, which is we print our way into oblivion, into a hyperinflation. And that is literally all we have left with this system. Unless we convert to a new system, this is all we have left. So MMT is not modern monetary theory. It's simply just the logical conclusion to a Keynesian economic cycle is all it is. And the central banks are talking about people QE in light of rates going more negative in Europe. Okay, U.S. deficits are hitting $1 trillion with no end in sight. We're talking about just deficits here. The difference between what we're spending and how much we need. So, or I'm sorry, what we're taking in and how much we're spending. And they keep going up. They keep going up. We have deficits now that are equal to the debt in 1983. That's correct. So we have a spending shortfall that is equal to the entire debt of the United States in 1983. This is getting serious, gang. Propaganda and hate, both parties agree on one thing. Spend more money. That's correct. That includes the Republicans. They are not conservative, but they also know we're finished. Now, when are they going to start being honest with us? They haven't hit that level yet about being honest with us, that we have to go through an enormous amount of pain and go through a new system. We have to literally go into a new financial system at the end of this. There is otherwise we just start trading with pebbles and goats and things. A monstrosity of a budget was agreed to by the House this week, further exacerbating deficits and raising the debt ceiling for another meaningless deadline. We'll see if it passes in the Senate. And it already passed in the Senate. So I think it's a done deal. I mean, this is just done. I did a podcast about this. So basically, this is it. He's saying here in the article, I'm highlighting this to make this clear. There are no solutions on the horizon. There is no dedicated, serious leadership on either side of the political aisle to address these structural solutions. None. Well, Rand Paul is talking about cutting spending, but he is on literally, let's say, a 20-year-old platform about cutting pork. We're past cutting pork. We have to cut everything. I mean, if they want to save the current system and literally stop this dead in its tracks, reverse it, they have to shrink the federal government down to less than 10% of its current size. That's how serious this is, gang. So, I mean, I'm just letting you know. I mean, this isn't, oh my gosh, I'm so depressed. I'm, going to take a bunch of sleeping pills. This isn't this. I'm telling you, I'm coming to a conclusion here in just a little bit. There's nothing but debt expansion and hope that the Fed can extend the business cycle by inflating stock prices to above 145% of GDP. That's it. Businesses are not investing in growth while consumers are loading up on credit card debt. Very important too. So basically, people have literally, they've exhausted their savings. They're going into credit card debt now. And what savings people have, what they think they have, is in their house and in the stock market, and both are in very serious bubbles. So that fail-safe, that safety net that they're going to depend on, is going to be gone. So this is why I've been talking about it's very important to try very, very hard not to take on new debt and to try to work on paying off existing debt. What do businesses know that consumers do not yet? Are businesses simply waiting for the China deal? Well, they may be waiting for a long time as Donald Trump dialed back expectations on Friday, suggesting China may want to wait to make a deal until after the 2020 election. Gang, this is very important too. And this is not a Trump bashing fest. This is just a reality. We heard nothing but lies from Trump and his administration about expectations on the China deal since literally last September. We have heard nothing but lies of how close they were to a deal, how well the negotiations were going. They were not going well at all. And I have said before, and I'll say one more time, Jim Willey with Golden Jackass newsletter has suggested that, and he is pretty sure this is what happened, China said in order for a trade deal to go forward, the United States had to stop manipulating the price of gold and silver. Trump said no. So China said no deal, and there's no negotiations happening anymore. We're in the midst of actually, many American corporations are now starting to get out of China. So it's over. China and the America are getting a financial divorce. That's what's going on right now, in my opinion. Businesses, or I'm sorry, I read that, are, let's see, whether posturing or not, basically there is no China deal and there's absolutely nothing that has changed on the structural growth front. But here we are. So this talks about the SPX and also market volatility, the VIX, and here we go, the VIX. And it's talking about how, basically we're starting to see patterns here where the markets may not hold for much longer. And we're talking about the stock markets. I don't know what to make of that either, guys, because we are in uncharted waters, as I said before. I don't know if this is going to hold or for how long it's going to hold, but mathematically it cannot. So eventually it's going to have to break. And unfortunately, with how hard and how much effort they have put into kicking the can down the road, into blowing up bubbles, when this goes, it's going to be absolutely devastating for the average American. You're going to lose a lot in this one here. And will America recover from it? I don't know. I mean, I just don't know. I mean, so will America be what it was, in the past? I doubt it. Because they literally will not let the business cycle complete. And Now this is now my speculation. This is Timmy Chonga's speculation. Because some of you are going to be asking, why won't they let the business cycle complete? And that's because they haven't finished draining off all the wealth from the middle class. And for the upper class, the low end of the upper class, they're on the, believe me, they're on the serving platter too. This is all about the 1% gang. The end of the Keynesian model serves to literally deliver on a silver platter all the wealth of the world to the upper class, the way, way upper class. And that's my speculation on this. They're not finished taking everything they can get yet. So, okay, off of the 2018 lows, the Fed capitulation and policy turn has produced a massive rally into key resistance zones in all markets, gang. We're seeing it happen. Markets are fully expecting a rate cut this week and have ignored all the negatives in the markets with the expectation that the Fed will spark another squeeze in equities. In 2007, the first cycle rate cut of 50 basis points led to, let's see, a 2-week rally for a final top. The rally here has entered a key resistance zone we've outlined to be a potential massive sell zone in equities. What the author of this article is saying is we are right now in that sell zone. Could happen at any time. This week and the one that follows may be the pivotal for this market. A breakout cannot be excluded as a possibility. Neither can a fake breakout that reverses or an outright violent rejection of the risk zone. What the Fed cannot afford is to disappoint markets or the political establishment that wants the Fed to cut rates aggressively. Politicians telling the Federal Reserve now what to do. Cut rates or the market dies. Investors are apparently unconcerned either way and are betting on a positive outcome as evidenced by a very low put-call ratio. So people are not betting on stocks going up or down right now. Okay, we're in a unique period in history. The end game is approaching. An extension of the market bubble above 145% stock market capitalization to GDP, or as a reversion back to a more historical mean, which is what the current technical and macro environment suggests. As suggests last week, this is a big battle for control. Investors are now pushing for a 10-year standing motto, "In Fed We Trust." Okay, gang, that's the article. I'm going to link it below, but I do think it's probably one of the best written articles that kind of, like I said, kind of put together everything that's been going on with these markets, everything that has happened literally since we went to emergency monetary policy here in the United States back in 2008. We have not been able to return to normal. So normal, what we used to know as normal, is gone forever. It will never come back. So we can expect prices on things to rise. You know, we can expect more monetary printing, and currency printing by the Fed. We can expect interest rates easing, and we can expect low interest rates for the coming future. I think we're going to go zero, and then below zero. Lynette Zhang at ITM Trading is pretty sure that in the end we'll be at negative 4% interest rates. So that does not help people with debt. All it does is it steals money from people who save. So that affects people who own bonds and people who save in currency. That's where it mainly affects you. So I wanted to talk about this. I wanted to provide a little perspective on this. And this article makes it sound pretty imminent. Next week or two is what the author of the article is saying. Does that mean we have a week or two until the bubbles start bursting? I don't know. I've given up trying to figure out when things are going to go haywire. But like I said, I do know that it's a good idea to keep getting undervalued assets. And, precious metals, cryptocurrencies, and even in mining shares like SILJ, which is an ETF of junior miners. And I'm not a financial consultant. So I don't want to say that this is the end-all be-all, this is what everyone should be doing with all of their money, with all of their savings. So I don't know what to tell you on that. But I am saying that the markets look wonky. Could they continue going up and crash through these resistance zones? Absolutely, they could. The sky's the limit. When the Federal Reserve keeps printing money and giving it to businesses and they keep buying back stocks, the sky's the limit, gang. Eventually, the businesses will own their own stocks and you and I can't buy them anymore. And not that I want them anyway, but I mean, it's just an example. So you look for companies that aren't doing stock buybacks. That would be an undervalued asset. But at the same time, you want to look at their PE ratio, and I still think 13 is probably a good number, to be looking at for PE ratios. I personally cannot get into the stock market right now for a variety of reasons, but the main reason is I just don't trust it. I just don't. This is the highest the stock market has ever been before. And if I were in any asset right now that was the highest that it's ever been before, I would literally have to think about my positions. There are undervalued assets out there, gang. Think about it. And also talk to your loved ones, talk to your friends. Let them know that bad things may be coming here real soon. I do think the Fed is going to lower interest rates on Wednesday. I really do believe that. It's either Tuesday or Wednesday. This coming up week. I do think they're going to do it, but it's not enough. So the markets may go higher, but the economy is still doomed. So if you want to buy into the doomed economy, then you can. If you want to buy into undervalued assets that are so unloved right now, like gold, silver, more specifically silver than gold right now, but cryptocurrencies, and mining stocks, possibly oil. Like I said, oil should be going down, but I have a feeling it's not. It's going to continue going up with all the tensions with Iran, but oil should be going down. Okay, I don't want to go on any longer. This has already gone on longer than I thought. But thank you very much for, tuning in to Truth, Money, and Freedom today. I want to say how much I appreciate all of you. I want to thank you for all the likes and for, the comments. Love the comments, all the shares. And we're going to try and get, Conjecture and I are going to try and get a podcast done tonight about the minimum wage. And you'll want to hear this one because basically it's very important that we get all aspects of the minimum wage in before we make a decision whether or not it's a good thing. But I'll let you wait for the podcast to see what the results of that are. But Conjecture's been working very hard on that. More so than I have because I've been working. I've been out working lately, and he's had a little bit more time than I did to get prepared for it. Okay, gang, you all have a wonderful rest of your Sunday, and may God bless each and every one of you.